Entering the stock market can feel like stepping into a vast ocean. While it offers exciting opportunities for wealth building, it also presents significant risks, especially for new investors. A key factor in being successful in the stock market is avoiding common mistakes that many beginner investors make. By understanding these mistakes and learning how to avoid them, you can improve your chances of making informed decisions, achieving financial goals, and growing your investment portfolio. In this video, we will explore the most frequent errors made by new investors and how you can avoid them. Mistake 1. Lack of proper research. One of the biggest mistakes new investors make is jumping into stocks without doing the necessary research. The stock market offers a vast array of companies and investment options, but making an investment decision without understanding the company or the industry can lead to poor outcomes. How to avoid it? Before investing in any stock, take the time to research the company's financial health, its industry, and its long-term growth prospects. Look at key financial metrics like earnings per share, price-to-earnings ratio, and dividend history to understand the company's performance and future potential. Additionally, keep an eye on market trends, competitors, and any news that might impact the company. Mistake 2. Trying to time the market. Many new investors fall into the trap of trying to time the market, hoping to buy low and sell high. While this may sound like a smart strategy, predicting short-term market movements is incredibly difficult, even for professional investors. Markets are influenced by numerous factors, including economic data, political events, and investor sentiment, all of which can be unpredictable. How to avoid it? Rather than trying to time the market, consider adopting a long-term investment strategy. A great way to do this is through dollar-cost averaging, which involves investing a fixed amount of money into a stock or fund at regular intervals, regardless of market conditions. This strategy helps to reduce the impact of short-term volatility and allows you to build wealth over time. Remember, it's often not about timing the market, but about time in the market. Mistake 3. Overtrading. Another common mistake is overtrading, buying and selling stocks too frequently. While it's tempting to act on every piece of news or market fluctuation, overtrading can lead to higher transaction costs, taxes, and emotional decision-making. This often results in poor returns over time. How to avoid it? Be mindful of your trading frequency. Keep a clear investment strategy and avoid making trades based purely on short-term emotions or market hype. Consider setting buy and sell targets for your investments and stick to them unless there is a significant change in the company's fundamentals. It's crucial to focus on long-term goals rather than reacting to every market swing. Mistake 4. Ignoring diversification. Diversification is a key principle of investing, yet many new investors fail to diversify their portfolios properly. Putting all your money into a single stock or a few stocks increases your risk because if those companies underperform, your entire portfolio can suffer. How to avoid it? Diversification helps reduce risk by spreading your investments across different assets, industries, and regions. Instead of focusing all your funds on a handful of stocks, consider building a diversified portfolio that includes stocks from various sectors, technology, healthcare, finance, as well as other asset classes like bonds and real estate investment trusts. A balanced approach can protect you from market volatility and give your portfolio the potential for steady returns. Mistake 5. Letting emotions drive decisions. Emotions like fear and greed are natural, but they can cloud your judgment when making investment decisions. Fear might make you sell stocks in a panic during a market downturn, while greed might push you to chase stocks that are performing well in the short term, but are actually overvalued. How to avoid it? One of the best ways to avoid emotional decision-making is to stick to a well-thought-out investment plan. Set clear goals for your portfolio, including investment time horizon and risk tolerance, and resist the temptation to make changes based on short-term market fluctuations. If the market experiences a downturn, stay calm and remember that investing is a long-term game. Mistake 6. Failing to set realistic expectations. It's easy to get caught up in the success stories of investors who have made huge gains in the stock market. While it's possible to achieve impressive returns, it's also important to set realistic expectations and understand that the stock market can be unpredictable. Expecting to make massive profits in a short time can lead to disappointment and poor decision-making. How to avoid it? Before investing, take the time to define what success looks like for you. Understand your risk tolerance and make sure your expectations align with the level of risk you are willing to take. Remember that steady, long-term growth is often more sustainable and rewarding than chasing high-risk, high-reward investments. A realistic approach will help you manage your expectations and avoid rash decisions. Mistake 7. Overestimating the importance of stock picking. Many new investors believe that picking individual stocks is the key to success. While individual stock picking can be profitable, it is often more difficult than it seems. Stock picking requires in-depth knowledge of the market and the companies you are investing in. Even the most experienced investors can struggle to consistently pick winning stocks. How to avoid it? Instead of trying to pick individual stocks, consider index funds or exchange-traded funds. These funds track a broad market index, such as the S&P 500, and provide exposure to a large number of companies. By investing in index funds or ETFs, you benefit from diversification and don't have to worry about picking individual winners. These options are often more suitable for new investors who are still learning the ropes. Mistake 8. Ignoring fees and taxes. Investment comes with various costs, including brokerage fees, management fees, and taxes. These costs can eat into your profits, especially if you're not careful. Some funds charge management fees that may seem small, but they can add up over time. Similarly, frequent buying and selling of stocks may trigger capital gains taxes. How to avoid it? Pay close attention to the fees associated with your investments, especially if you are investing in mutual funds or ETFs. Look for funds with low expense ratios and be mindful of transaction fees, as they can quickly reduce your returns. Additionally, consider the tax implications of your investments. Holding investments for over a year before selling can help you qualify for long-term capital gains tax rates, which are often lower than short-term rates. Mistake 9. Not having a plan for risk management. Stock market investing inherently involves risk. Some investors, especially beginners, may ignore the importance of risk management, leading to excessive exposure to stocks that could lose value quickly. How to avoid it? Before making any investment, consider your overall risk profile. This includes understanding how much loss you're willing to tolerate in your portfolio before making changes. You can manage risk by setting stop-loss orders that automatically sell a stock if it drops to a certain price, or by diversifying your investments across different sectors. Having a clear plan in place for managing risk ensures that you're prepared for unexpected market events and can protect your investments over time. Mistake 10. Failing to monitor your investments regularly. After investing, some new investors make the mistake of not monitoring their portfolios regularly. Over time, market conditions change, and your investments might need adjustments to stay aligned with your goals. By neglecting your portfolio, you risk losing touch with important market shifts. How to avoid it? Set a schedule to review your portfolio periodically, whether it's monthly, quarterly, or annually. Assess the performance of your investments, track any changes in the market or company fundamentals, and adjust your portfolio accordingly. Regular monitoring ensures that your investments remain aligned with your long-term goals and that you're making the best decisions for your future. Investing in the stock market offers significant potential for growth, but it also comes with risks, especially for beginners. By avoiding common mistakes such as failing to do proper research, trying to time the market, and letting emotions dictate your decisions, you can significantly improve your chances of success. The key to long-term success in investing is adopting a disciplined, well-researched approach and sticking to your plan. Remember, investing is a journey, and patience, education, and strategy are your best allies. If you found this video helpful, be sure to subscribe for more tips on successful investing and wealth-building strategies.